In the ever-evolving world of cryptocurrency, the dream of financial freedom often begins with a spark. A viral success story, a friend who doubled their money overnight, or a social media influencer flashing luxury cars and calling it crypto profits. This illusion of effortless wealth is what traps most beginners before they even understand what they're stepping into. The idea that crypto is a shortcut to riches is seductive, but it's also one of the most dangerous misconceptions a new trader can have. Many enter the market thinking they've discovered a gold mine, only to realize too late that what looked like easy money was actually a high-risk battlefield of volatility, psychology, and manipulation. The truth is, over 90% of new investors lose money in crypto, not because they picked the wrong coin, but because they walked into the market unprepared, driven by emotion rather than strategy. Imagine someone trying to sail a ship in stormy waters without knowing how to navigate. No matter how strong the vessel, it's bound to sink. In crypto, your knowledge and discipline are your compass and anchor. Without them, every market pump looks like an opportunity, and every dip feels like a disaster. The problem isn't that the market is cruel. It's that most people underestimate how complex and psychological trading really is. The illusion of getting rich quick spreads faster than the truth because it appeals to our deepest desires: freedom, success, and validation. Many new traders skip the learning phase and jump straight into investing, often influenced by hype-driven social media posts or crypto gurus promising 10x returns. They buy coins they don't understand, follow trends they can't explain, and when the market inevitably corrects, panic sets in. Suddenly, the same person who believed they'd become a millionaire is selling at a loss, blaming the market, when the real issue was their mindset from the start. To succeed in crypto, one must first understand that this market rewards patience, not impatience, discipline, not excitement. Crypto is a tool, a revolutionary financial system built on technology, not luck. Like any tool, it can build or destroy depending on how it's used. Every successful investor you've ever heard of, whether it's someone who turned a few $100s into millions or consistently grows their portfolio, learned this lesson early. They treat the market with respect, not greed. In essence, the foundation of success in crypto isn't about chasing profits, it's about avoiding mistakes. The more you learn to sidestep emotional decisions, impulsive trades, and hype-driven investments, the longer you'll stay in the game. And staying in the game is what allows opportunities to find you. In crypto, survival comes before success. So as we journey through the 10 deadly mistakes that ruin traders, remember this simple truth. You don't have to be perfect to win in crypto. You just have to avoid being careless. One of the deadliest mistakes new crypto traders make is chasing hype and meme coins, driven by the fear of missing out, better known as FOMO. Every bull run has its stars, flashy tokens that skyrocket overnight, fueled by viral tweets, celebrity endorsements, and social media frenzy. To beginners, these coins look like golden tickets, quick, easy, and guaranteed profits. But beneath the surface, these hype-driven projects are often built on weak fundamentals, inflated promises, and emotion rather than actual utility. When you scroll through X, formerly Twitter, or Telegram groups, you'll see hundreds of people bragging about how they just doubled their bag or caught the next 100x gem. It's human nature to want to be part of that success story. But here's the truth. By the time you're hearing about a coin everywhere, it's already too late. The early adopters, often the developers and insiders, are already selling their holdings to the new wave of hopeful investors who are buying at the top. It's a classic cycle of greed and fear. You join in excitement, thinking you're early, but you're actually providing exit liquidity for someone else's profit. Take Dogecoin and Shiba Inu, for instance. During their hype cycles, millions jumped in after seeing celebrities like Elon Musk tweet about them. Some early investors indeed made life-changing profits. the lucky few who bought before the frenzy. But for every success story, there were countless silent losses. When the hype faded, prices crashed, leaving latecomers holding worthless bags. These tokens had one thing in common: a strong narrative, but weak fundamentals. They thrived on attention, not adoption; memes, not meaningful innovation. Let's illustrate this further. Imagine two traders. Trader A buys a meme coin because it's trending and promises to-the-moon gains. Trader B spends time researching a project solving real-world problems, maybe a blockchain focused on faster transactions, decentralized storage, or cross-chain interoperability. A few weeks later, the hype around Trader A's coin fades and the price crashes by 80%. Meanwhile, Trader B's project grows steadily as it gains users and partnerships. Who do you think wins in the long run? The answer is clear: the one who valued fundamentals over hype. To avoid this trap, new traders must adopt a disciplined approach rooted in research, not reaction. Step 1. Before investing in any coin, understand what problem it solves. If there's no clear purpose beyond making people rich, that's a red flag. Step 2. Check the team behind it. Are they transparent, experienced, and active in development? Step 3. Study the tokenomics. How is the coin distributed, and who holds most of the supply? Step 4. Look at real partnerships, community strength, and long-term goals. The market doesn't reward those who move the fastest. It rewards those who move the smartest. Every time you feel tempted to jump into a trending coin, pause and ask, is this hype or substance? If the only reason to buy is because everyone else is doing it, that's your signal to step back. In the crypto world, research will always beat hype. The difference between a gambler and an investor is understanding why you're buying. Meme coins might deliver quick dopamine hits, but strong, utility-driven projects are what build lasting wealth. In short, don't chase the noise, chase the knowledge. Another mistake is emotional trading, fear and greed cycle. Emotional trading is one of the most destructive habits in the crypto world, and ironically, it's also one of the easiest traps to fall into. The market moves fast, often violently, and the roller coaster of price swings can turn even the calmest investor into an emotional wreck. Fear and greed are the two forces that dominate this space. When prices soar, greed whispers, "Don't miss out, buy now." When the market crashes, fear screams, "Sell everything before you lose it all." This constant back and forth leads countless traders into the same deadly cycle, buying high when emotions are euphoric and selling low when panic takes over. Let's imagine a scenario. You see Bitcoin climbing rapidly, social media is exploding with excitement, and everyone seems to be making money. Your logical mind says, wait for a dip, but your emotions take the wheel and you buy at the top. Then, just days later, the market corrects sharply, and that same excitement turns into anxiety. The charts are red, influencers go silent, and the voice of fear starts to grow louder. In panic, you sell at a loss, only to watch the market recover shortly after. This cycle repeats itself until the emotional trader realizes that the real enemy isn't the market, it's their own mind. Successful crypto trading requires mastering psychology as much as strategy. The best traders understand that emotions cloud judgment, distort perception, and trigger impulsive decisions. They know that every trade should have a plan, an entry point, an exit point, and a reason backed by analysis, not impulse. When you make decisions based on emotion, you're reacting to noise rather than responding to information. The difference between reacting and responding can determine whether you grow your portfolio or destroy it. So how do you break free from the fear and greed cycle? The first step is to embrace discipline and structure. One of the most powerful strategies to neutralize emotional trading is dollar cost averaging, DCA. Instead of dumping all your money into a coin at once, DCA involves investing a fixed amount at regular intervals, regardless of market conditions. This method removes the emotional pressure of timing the market and helps smooth out volatility over time. Another essential tool is setting stop losses, predetermined levels where you automatically sell a position to prevent deeper losses. It's like installing a safety net before walking a tightrope. Next, consider keeping a trading journal. Write down why you entered each trade, your emotional state at the time, and the outcome. Over time, you'll start to see patterns in your decision-making. Maybe you tend to buy impulsively after a friend's success story, or perhaps you panic sell after 2 days of red candles. Awareness is the first step toward control. Mindset plays a massive role too. The crypto market is unpredictable and no one can catch every move perfectly, except that losses are part of the process. What separates pros from amateurs is how they respond to them. Professionals use losses as feedback. Amateurs use them as fuel for emotional decisions. In the end, logic always beats emotion in the long run. The traders who survive and thrive are those who think like chess players, not gamblers, always planning several moves ahead, detached from temporary market noise. Remember, the market rewards patience, not panic. When you learn to trade with logic instead of emotion, you stop being a victim of volatility and start using it to your advantage. Emotional trading and lack of discipline often push traders into another equally dangerous territory, putting all their hopes on one coin. After making a few emotional trades, many beginners convince themselves that one perfect project will save them or make back all their losses. They start chasing that one coin that feels safe, familiar, or hyped, forgetting that the crypto market doesn't reward blind loyalty. What begins as emotional recovery quickly turns into overconfidence, and before they know it, they've gone all in on one asset. This leads us to the next deadly mistake: ignoring diversification. One of the most overlooked yet devastating mistakes crypto traders make is ignoring diversification, the dangerous act of going all in on a single coin. It's tempting to believe that one lucky bet can change everything. You find a project you're passionate about, the charts look promising, and the hype feels irresistible. But in crypto, even the strongest-looking coins can crash unexpectedly. Regulatory changes, exchange hacks, developer issues, or simple shifts in market sentiment can erase months of gains in hours. Putting all your money into one asset is like sailing with no lifeboat. When the storm hits, there's nowhere to escape. Diversification is more than just spreading money around. It's a survival strategy designed to protect you from the crypto market's inherent volatility. Every coin carries its own level of risk and reward, and no matter how confident you feel, there's always uncertainty. Think of your crypto portfolio like a football team. Bitcoin might be your star striker, Ethereum your playmaker, and smaller altcoins your experimental forwards. If one player underperforms, the others can still keep you in the game. That's what diversification does. It ensures that one bad move doesn't wipe you out completely. To build a balanced crypto portfolio, it helps to understand how different categories of assets behave. Bitcoin is often considered the foundation, the digital gold of crypto. It's not the most explosive, but it offers stability and long-term credibility. Ethereum adds flexibility and growth potential because of its smart contract ecosystem that powers thousands of decentralized apps. Then you have mid-cap coins, established projects with strong fundamentals but higher risk and reward potential. These could include protocols in DeFi, gaming, or blockchain infrastructure. Lastly, small-cap coins are like startups. They can deliver massive returns, but they also carry the highest risk. Allocating a small percentage of your portfolio to them can be strategic, but going all in is gambling, not investing. Let's put it into perspective. Imagine two traders. Trader A invests everything in a single altcoin that promises revolutionary technology. When the project faces issues or loses community trust, its price collapses by 90% and the trader's portfolio follows. Trader B, on the other hand, splits their investments wisely: 50% in Bitcoin and Ethereum for stability, 30% in mid-cap projects for growth, and 20% in small caps for high-risk opportunities. When one project fails, others balance the losses. Trader B doesn't panic because diversification softens the blow. It's also important to diversify across sectors, not just coins. For instance, you might hold assets from different categories: DeFi, Layer 1 blockchains, AI-related projects, and NFTs. Each reacts differently to market conditions, so when one sector is down, another might be booming. This multi-angle approach helps keep your portfolio afloat even when part of the market crashes. Diversification doesn't mean you'll always make money. It means you'll stay alive long enough to make it. The crypto market is unpredictable, and even experts can't foresee every dip or regulatory move. But spreading your risk ensures you're not wiped out by a single event. It's a form of emotional insurance, too. When you know not all your eggs are in one basket, you can think and act with more clarity and less panic. At its core, diversification is about respecting the unpredictability of the market. No matter how confident you are in a project, anything can happen. And that's exactly why diversification exists. In crypto, your goal isn't just to make profits, it's to protect them. The market rewards the cautious and punishes the careless. So remember, in volatile markets, diversification isn't just smart, it's survival. Another costly mistake that ruins countless crypto traders is selling too soon, or worse, panic selling. After the emotional roller coaster of chasing hype and watching prices swing wildly, many beginners develop a reactionary mindset. The moment they see a little profit, they rush to sell out of fear that the gains will disappear. Or, when the market dips sharply, they panic and dump their holdings to cut losses, only to watch prices rebound days or weeks later. These emotional reactions create a painful cycle: selling low, buying high, and never truly capturing the rewards of long-term investing. Crypto markets are famous for their volatility. Prices can rise or fall 20% in a single day, sometimes for no apparent reason. For newcomers, this level of turbulence feels unbearable. But what separates successful investors from short-term traders is patience and conviction. The market constantly tests your emotions, shaking out those who don't have a clear strategy or belief in their investments. It's not the dips that destroy most traders, it's their inability to stay calm through them. Consider this. In Bitcoin's early days, thousands of people bought when prices were just a few dollars or even cents. Many sold their holdings after doubling or tripling their money, thinking they'd made a smart move. But those who held through the ups and downs, through crashes, fear, and uncertainty, were the ones who eventually reaped life-changing gains. The same story repeated itself in later cycles. Each time Bitcoin hit a new all-time high, many early sellers realized too late that they had traded long-term potential for short-term comfort. The lesson here is simple but powerful. Time in the market beats timing the market. Trying to perfectly predict highs and lows is a losing game, even for professionals. Instead of constantly reacting to short-term price movements, the goal should be to understand the long-term value of your investments. If you believe in a project's fundamentals, its technology, team, and adoption, then short-term fluctuations are just noise. The market rewards those who can endure temporary pain for long-term gain. To avoid the trap of panic selling, start by building a plan before you invest. Decide in advance your entry point, profit targets, and conditions under which you'll sell, and stick to them. Use stop-loss orders to manage risk, and take profit targets to lock in gains methodically, not emotionally. Most importantly, zoom out. When you look at a one-day or one-week chart, every movement feels dramatic. But when you view the 1-year or 5-year chart, the temporary dips fade into the background, and you start to see the bigger picture of growth and opportunity. Patience in crypto isn't passive, it's a strategic discipline. It means trusting your research, ignoring the noise, and letting time do the heavy lifting. Remember, the people who panic sold Bitcoin at $200 never imagined it would one day reach tens of thousands. Likewise, those who stay grounded and informed today could be tomorrow's success stories. In the unpredictable world of crypto, the strongest advantage you can have isn't speed, it's conviction. Selling too soon or panicking during a market dip often leaves traders feeling frustrated and desperate to make back what they've lost. That emotional impulse to recover quickly can lead to reckless decisions, like jumping back into trades without a plan, increasing position sizes, or even using leverage to multiply potential gains. Unfortunately, this is exactly how many traders fall into the next deadly trap: ignoring risk management. Ignoring risk management is one of the most dangerous and costly mistakes a crypto trader can make. It's the silent killer of portfolios, the downfall that doesn't come from one bad trade, but from a lack of structure and control. Many beginners enter the market focused only on profits, forgetting that the first rule of trading isn't to win big, it's to avoid losing everything. Without a clear risk management plan, even a winning streak can end in disaster. In crypto, where prices can swing by double digits in hours, protecting your capital is not optional, it's survival. One of the most common signs of poor risk management is trading without stop losses or exit strategies. A stop loss is a simple yet powerful tool that automatically closes your position when the price drops to a certain level, preventing further losses. Yet many traders skip it because they believe they can watch the market or know when to exit. The problem is, when emotions take over, logic disappears. Instead of cutting losses early, they hold on, hoping the price will bounce back, and by the time they realize it won't, their portfolio has already taken a serious hit. Equally dangerous is over-leveraging or using borrowed funds to increase position size. Leverage amplifies both gains and losses, and while it can look tempting, it's a double-edged sword. Many traders get liquidated not because they chose the wrong coin, but because they underestimated how quickly a leveraged position can turn against them. Imagine borrowing 10x your capital to chase a short-term move. A mere 10% dip in price could wipe out your entire account. What was meant to accelerate profits becomes a shortcut to total loss. Professional traders use leverage cautiously and strategically, but beginners often treat it like a fast track to wealth. In reality, it's a trap designed for the impatient. Risk management also involves position sizing, deciding how much of your capital to allocate to a single trade. A common rule among seasoned traders is never to risk more than 1 to 3% of your total portfolio on a single position. This ensures that even if a trade goes wrong, you live to trade another day. Crypto is unpredictable. No matter how strong your analysis, unexpected news, market manipulation, or black swan events can flip the market instantly. The goal is to stay in the game long enough to benefit from the opportunities that follow. Understanding your risk tolerance is equally critical. Everyone's financial situation and emotional endurance are different. A drop that feels manageable to one trader might cause another sleepless nights and panic decisions. Before you enter any position, ask yourself, if this trade fails, how much can I afford to lose without jeopardizing my peace of mind? That question alone can save you from ruin. In the end, risk management is about mindset. It's the art of thinking like a professional rather than a gambler. Professionals know that every trade carries uncertainty, so they focus on probabilities, not predictions. They protect capital first, because without capital, there's no opportunity to profit later. The amateurs, however, chase quick wins and ignore the downside until it's too late. Always remember this golden rule: protect capital before chasing profit. The market will always offer another opportunity, but only if you still have funds to take it. Risk management may not sound exciting, but it's the difference between surviving one bull run and thriving through many. In crypto, it's not just about how much you make, it's about how much you keep. However, you can have the perfect portfolio balance, disciplined trading habits, and a solid profit plan, and yet lose everything overnight if your assets aren't properly protected. After all, what good is managing your risks in the market if you leave the door wide open for hackers and scammers? That's where the next deadly mistake comes in: neglecting security practices. In the crypto world, where transactions are irreversible and there's no customer service to call when something goes wrong, neglecting security practices can be an unforgivable mistake. Many traders focus so much on profits, price movements, and portfolio growth that they forget one essential truth: if your assets aren't secure, they don't belong to you for long. Unlike traditional banking, where lost funds can sometimes be recovered, in crypto, a single lapse in security, one careless click, one misplaced key, can mean losing everything permanently. The most common security mistakes come from convenience and overconfidence. Beginners often store their coins in hot wallets while it's connected to the internet because they're easy to use for trading. But what's convenient for you is also convenient for hackers. Exchanges and online wallets are prime targets for cyber attacks, and even reputable platforms have been compromised in the past. When you leave your funds in an exchange wallet, you're effectively handing over control to a third party. As the saying goes, not your keys, not your coins. Phishing attacks are another major threat. Scammers craft convincing websites, emails, and even fake apps that mimic legitimate crypto platforms. One click on a fake link or one mistyped web address can lead to your private keys being stolen. It's frighteningly common for users to connect their wallets to malicious sites disguised as airdrop claim pages or token swap platforms. Once access is granted, the attacker drains everything within seconds, and there's no reversing it. Sharing your recovery phrase or private key, even accidentally, is another fatal error. No legitimate service will ever ask for it, yet countless traders lose funds each year by trusting the wrong source or falling for urgent-sounding scams. The solution lies in practicing digital self-defense. Step 1 is to invest in a hardware wallet, such as Ledger or Trezor, to store your crypto offline. These cold wallets keep your private keys disconnected from the internet, making it almost impossible for hackers to access them remotely. Step 2 is enabling two-factor authentication, 2FA, on every exchange or crypto-related account. This adds a second layer of protection even if your password gets compromised. Step 3 is to stay vigilant. Always double-check URLs, bookmark official websites, and avoid clicking on links sent through messages or emails. It's also wise to maintain a separate device for trading and wallet management, away from casual browsing or app installations. Simple habits like using strong, unique passwords and regularly updating your software can significantly reduce risks. And for those who manage larger sums, consider multi-signature wallets, where multiple approvals are required to move funds, an extra shield against both hackers and human error. Ultimately, security in crypto isn't about paranoia, it's about responsibility. You are your own bank, and that means your safety depends on your actions. The market can recover from a crash, but stolen crypto rarely finds its way home. Many investors have learned this lesson the hard way, losing fortunes not through bad trades, but through preventable security lapses. So never underestimate this truth: if you lose your keys, you lose your crypto. In an ecosystem built on decentralization, control comes with accountability. Protecting your assets isn't just good practice, it's the foundation of surviving and thriving in the crypto space. Another deadly mistake that quietly destroys many crypto traders is the lack of education and proper research. In a market that moves at lightning speed, filled with complex technologies and constantly evolving trends, ignorance is far more expensive than any bad trade. Many beginners jump into crypto with excitement but little understanding of what they're actually investing in. They hear about blockchain, NFTs, or DeFi, but never take the time to learn how these systems work. They see a coin trending on social media and buy impulsively, not because they understand its purpose or tokenomics, but because everyone else seems to be doing it. This lack of foundation is the reason so many investors lose money. They treat crypto like a casino rather than a financial ecosystem built on technology and innovation. Without understanding how blockchain operates, how transactions are verified, what gives tokens value, or how supply and demand shape prices, it's impossible to make informed decisions. Tokenomics, for instance, can reveal a lot about a project's sustainability, who controls the supply, how tokens are distributed, and whether the project's design encourages long-term growth or short-term manipulation. Yet most beginners skip this step entirely, choosing hype over homework. Crypto isn't just another asset class, it's an entire technological revolution. The landscape is filled with smart contracts, decentralized applications, and emerging innovations that can change how industries operate. But because it evolves so quickly, what you know today can be outdated tomorrow. That's why continuous learning isn't optional, it's essential. Traders who succeed long-term are those who commit to staying curious, studying trends, understanding use cases, and questioning everything before investing. Let's consider an example. Imagine two investors entering the market at the same time. The first one relies on social media for trade ideas, chasing every trending coin and rumor. The second takes time to study, reading white papers, following credible analysts, and understanding how market cycles work. A few months later, when the hype fades and the market corrects, the first investor panics, while the second calmly adjusts their strategy, knowing exactly why they're holding certain assets. Knowledge gives confidence, and confidence prevents emotional mistakes. Learning in crypto doesn't have to be overwhelming. You can start small. Step 1. Learn the basics of blockchain technology and how transactions work. Step 2. Understand key metrics like market cap, circulating supply, and total value locked, or TVL, to assess a project's strength. Step 3. Follow reliable educational sources and independent analysts instead of hype-driven influencers. Step 4. Read project white papers before investing a single dollar. If a project can't clearly explain what it does and how it benefits users, that's a red flag. Education also protects you from scams. Many fraudulent projects thrive on the ignorance of investors who don't ask questions. They promise huge returns, but a closer look often reveals vague goals, anonymous teams, or unrealistic tokenomics. A bit of research up front can save you from massive losses later. At the end of the day, knowledge is your greatest weapon in crypto. Markets will rise and fall, trends will change, and new technologies will emerge, but the educated investor always finds their footing. Every hour you spend learning compounds over time, just like a good investment. So remember, education isn't a distraction from trading, it is trading. In this space where the unprepared get left behind, one truth stands firm. Education is your ultimate investment. One of the biggest reasons traders fail in crypto isn't the volatility of the market, it's the lack of a clear strategy or plan. Too many people enter the space without defined goals, no sense of direction, and no idea when to buy, sell, or even stop trading. They operate purely on instinct or impulse, jumping from one coin to another based on whatever's trending that week. In a market as unpredictable and fast-paced as crypto, this kind of aimless approach is a recipe for disaster. Without a plan, you're not trading, you're gambling. A clear strategy serves as your roadmap in the chaos of crypto. It helps you stay focused when the market tempts you with quick profits or scares you with sudden dips. For instance, are you investing or trading? The difference matters. Investors focus on the long-term potential of solid projects, holding through market cycles, accumulating during dips, and letting time work in their favor. Traders, on the other hand, aim to capitalize on short-term price movements, often using technical analysis and strict risk management. Confusing the two is dangerous. Many beginners claim they're long-term investors when prices drop, not because of strategy, but because they're trapped in a losing position. Without a defined plan, emotions take over. You start chasing every green candle, selling too early, or holding too long. But with a system in place, you replace emotional reactions with calculated decisions. A proper strategy should outline your entry points, exit targets, and profit goals before you even place a trade. It should also define your risk tolerance, how much of your capital you're willing to lose on any single position. This transforms trading from a guessing game into a structured process. One practical way to build and stick to your plan is by tracking and journaling your trades. Document each trade, why you entered, what indicators you used, how you felt, and what the outcome was. Over time, you'll notice patterns in your decision-making, allowing you to refine your strategy and avoid repeating past mistakes. Pair this with portfolio tracking tools that help you monitor performance, rebalance your holdings, and keep an eye on your exposure to different sectors. This habit turns trading into a discipline, not a gamble. Regular review and reflection are equally important. Set aside time weekly or monthly to assess your performance, what worked, what didn't, and why. This habit builds self-awareness and helps you evolve as a trader. Remember, even the best strategy won't be perfect forever. The crypto market evolves quickly, and flexibility is part of planning. You must be willing to adjust your system as new information, technologies, and market trends emerge. The truth is, failing to plan is planning to fail. The traders who survive and thrive in crypto are not the ones with the most luck, but the ones with the most structure. They know when to act and when to wait. They understand that discipline is more valuable than intuition. A solid strategy protects you from emotional chaos, keeps your actions aligned with your goals, and ensures that every trade, win or lose, moves you closer to long-term success. In crypto, where the market can turn against you in minutes, a plan isn't optional. It's your shield. Without it, every decision is a gamble. But with it, every decision becomes a step toward mastery. Another deadly mistake in crypto, and perhaps one of the most overlooked but deadly mistakes in crypto trading, is impatience and the lack of a long-term vision. Many newcomers step into the crypto world expecting instant success. They want to double their money in days, flip a coin overnight, or catch the next moonshot that turns them into millionaires. This mindset is understandable. After all, social media is filled with stories of people who made life-changing gains in short periods. But what most don't realize is that for every viral success story, there are thousands of traders who lost everything chasing the same dream. Impatience is the silent killer of progress in crypto. It pushes traders to abandon well-thought-out strategies, to sell too soon during small dips, or to jump from one project to another without giving any of them enough time to mature. The truth is, real wealth in crypto is built through time, discipline, and understanding cycles, not through constant switching or emotional decision-making. Every major crypto success story you've heard about, whether it's Bitcoin, Ethereum, or Solana, involved years of holding, learning, and enduring painful drawdowns before the massive payoffs came. The crypto market operates in cycles, periods of bullish excitement followed by harsh corrections. The impatient trader buys during the hype and sells in panic when the market turns. The patient investor, on the other hand, uses those same downtrends as opportunities to accumulate strong assets at discounted prices. They understand that corrections aren't failures, they're part of the process. Time in crypto is your greatest ally if you know how to use it. Let's put this into perspective. Imagine two traders. One checks prices every hour, constantly adjusting trades, worrying about every small fluctuation. The other sets clear long-term goals, researches solid projects, and allows time for compounding growth. Over months and years, the second trader experiences fewer emotional swings and sees better returns. Why? Because the market rewards patience, not panic. Quick profits may happen occasionally, but sustainable success comes only to those who respect time. Step 1. Understand that volatility is normal. Crypto prices can rise or fall 20% in a day, and that doesn't always mean something's wrong. Step 2. Learn the historical patterns, how Bitcoin's halving cycles and macro trends shape the broader market. Step 3. Build your strategy around years, not days. This doesn't mean ignoring opportunities, but rather aligning your actions with a long-term growth mindset. Step 4. Avoid burnout by setting realistic goals and taking breaks from constant chart watching. Trading should serve your life, not consume it. Many traders lose sight of the bigger picture because they focus only on today's price instead of tomorrow's potential. Bitcoin didn't become valuable in a few weeks. It took more than a decade of adoption, development, and global recognition. The same goes for countless other solid projects that started small but grew steadily over time. Those who lacked patience missed the journey. The bottom line is simple. The long game always wins. In crypto, time in the market is infinitely more valuable than timing the market. Every moment you spend learning, observing, and staying consistent builds your foundation for lasting success. When you think long-term, short-term losses become lessons, not failures. And that shift in mindset, from instant gratification to strategic patience, is what separates true investors from those who merely chase trends. As we've journeyed through these critical lessons, it's clear that surviving and thriving in the crypto market isn't just about making smart trades. It's about avoiding the traps that destroy so many beginners. We've covered emotional discipline, risk management, patience, strategy, and the importance of education. Each of these mistakes can single-handedly derail your progress if ignored. Now, as we reach the final mistake in our list of the 10 deadly mistakes every crypto trader must avoid, we turn our attention to one that often gets overlooked, not because it's less important, but because it's less glamorous. While traders focus on charts and profits, they often forget that success in crypto isn't just about earning, it's also about protecting what you earn. This brings us to the 10th and final mistake, ignoring taxes and regulations. It's the silent threat that can undo even the most profitable portfolio if left unchecked. After mastering patience and adopting a long-term mindset, many traders start feeling confident, sometimes too confident. They focus on growing their portfolios, finding new opportunities, and refining their trading skills. But in this pursuit of profit, there's one crucial aspect many ignore until it's too late: taxes and regulations. It might not be as exciting as chart analysis or bull run predictions, but overlooking it can lead to serious consequences that wipe out years of progress. Many beginners assume crypto exists outside the traditional financial system, that because it's decentralized, it's also invisible to governments and tax authorities. This is one of the most dangerous misconceptions in the space. In reality, most countries now have clear or emerging laws that define how crypto transactions are taxed, tracked, and reported. Whether you're trading, staking, or earning through airdrops, each of these activities can carry different tax implications. Failing to understand or report them properly could lead to fines, audits, or even legal trouble. Let's put this in perspective. Imagine spending years building your portfolio only to lose a significant portion of your gains to unexpected tax liabilities. Many traders have learned this the hard way. During bull runs, profits feel limitless. But when tax season arrives, those same traders realize they owe more than they expected because they never kept records or understood capital gains rules. A simple lack of awareness can turn success into stress. That's why understanding your local crypto tax laws is not just about compliance, it's about protecting your profits. Take the time to learn whether your country taxes crypto as capital gains, income, or a hybrid model. Know how long you need to hold assets to qualify for reduced rates, and whether converting crypto to stable coins or NFTs triggers a taxable event. These details may seem small, but they can make a massive difference in your net returns. Practical steps can make this easier. Step 1. Keep detailed records of all transactions, buys, sells, swaps, and transfers. There are excellent crypto portfolio trackers and tax software tools designed specifically for this purpose. Step 2. Consult a tax professional who understands digital assets, especially if you trade actively or operate across multiple exchanges. Step 3. Stay updated on regulations because crypto laws evolve quickly. What was acceptable last year may not be compliant this year. Regulatory awareness isn't just about taxes, it's also about staying safe from legal and operational risks. Knowing which exchanges are licensed in your region, understanding KYC AML, know your customer and anti-money laundering requirements, and following proper reporting procedures help you build credibility and security as an investor. Ignoring these rules might work temporarily, but it always catches up in the end. In crypto, smart investors don't just chase profit, they protect it. That protection includes managing risk, safeguarding assets, and staying compliant with the law. Because at the end of the day, it's not how much you make that matters, but how much you keep. The final lesson is clear. Smart investors protect both profits and compliance. Understanding taxes and regulations isn't a burden, it's a strategy. It's what separates amateurs who gamble from professionals who build lasting wealth with confidence and integrity. Every successful crypto trader you see today didn't just master the markets, they mastered themselves. The truth is, success in crypto isn't only about spotting opportunities, it's about avoiding the mistakes that destroy them. Each of the 10 deadly mistakes we've explored, from chasing hype to neglecting security and ignoring taxes, serves as a crucial reminder that preparation, discipline, and patience will always outperform luck and emotion. Avoiding these mistakes doesn't mean you'll never face losses or setbacks, but it does mean you'll grow faster, recover smarter, and trade with greater confidence. Each lesson you apply moves you one step closer to mastery. Over time, what once felt overwhelming will start to make sense, because in crypto, knowledge compounds just like wealth. Remember this, the best traders aren't those who never make mistakes, but those who learn from them and never repeat them. Build your foundation on education, protect your capital with discipline, and approach every trade with a plan and purpose. That's how you transform confusion into clarity, risk into strategy, and mistakes into mastery. If you found value in these lessons and want to keep sharpening your crypto knowledge, subscribe to Crypto Education Zone, CEZ, where we break down complex crypto topics into simple, actionable insights to help you build long-term wealth the smart way. Remember, in the world of crypto, knowledge isn't just power, it's your greatest edge. Keep learning, keep questioning, and keep building your conviction.